Good morning. It's Monday, the 15th of April, and this is Govindraj Ethiraj broadcasting and streaming from Mumbai, India's financial capital. Our top stories and themes for the day. Tensions in the Middle East spike after Iran fires missiles into Israel. The markets brace for corrections. Gold prices jump again as war risk premiums rise across commodities. How goods and service tax numbers demonstrate the lag effect of reforms even as they tell us more than perhaps we know about the economy. And the government invokes an emergency clause to activate underutilized gas-powered plants.
This is a core report with Govindraj Ethiraj.
The markets are set to be weak and subdued on Middle East tensions. So before we come to Monday, Friday was a down day for the stock markets with the Sensex falling 793 points to 74,244 and the NSE Nifty falling 234 points to 22,519. Thursday, the day before that, was closed for Eid, so it was a market-shortened week. The reason the markets were down on Friday was mostly to do with the fact that inflation came in higher in the United States on Wednesday than expected, which in turn meant a possible delay in interest rate cuts. While on the other hand, wholesale inflation data in the United States was more palatable, the net effect was still negative. Now, there was also some concern about a changed tax regime for investors who come in via Mauritius, but it appears that there is no date yet set for ratifying of those new tax rules. The changes would mean that you will need to show that you're actually doing business in Mauritius to claim tax benefits as opposed to the largely post-pox version of companies incorporated in Mauritius routing money into India right now. Now, that is, of course, very simply put, but hopefully should do for now, and it may not have been a significant reason from at least what I can see. Looking ahead, we have yet another holiday-shortened week, with Wednesday being a trading holiday for Ram Navami. The overhang is obviously the tensions in the Middle East, which have risen to fresh levels after Iran let loose a barrage of missiles and drones towards Israel, which appeared more to demonstrate it would not sit quiet after its embassy in Syria was bombed by Israel. Gold and oil will be watched closely, and obviously gold matters more in the shorter or even medium term because it's something that you could buy or sell as opposed to oil, a rise in the prices of which will affect you, but only much later if so. And we will come to gold in some more detail shortly. Several results are expected this week, including earnings from Infosys, Wipro, and Bajaj Auto. Speaking of earnings, TCS reported its January to March quarterly earnings on Friday, reported a 9% growth in net profit to about 12,400 crores in that fourth quarter. Interestingly, this is apparently more thanks to strong domestic business, which is those higher numbers, rather than international, which is under pressure for all IT services companies, as I'm sure we will see in coming days. For the full year, and it's good to know these numbers, TCS net profit went up 9% to 45,900 crores, or almost 46,000 crores, while revenue was up to about 241,000 crores from around 225,000 crores a year ago. Elsewhere, retail inflation was down to a 5-month low of 4.8% in March, thanks to food prices cooling off somewhat, while industrial production increased to a 4-month high of 5.7%. So the economists I've been speaking to say that there is no clear trend that's coming from all of this, and some of these numbers have also been along expected lines, at least broadly. The only trend that does emerge is that we are likely to be driven more by external triggers for some time now, or maybe till election results are out in June, as we've been saying, at which point the market might seek and align itself to fresh targets. War risk premiums, the new factor to factor in. Speaking of triggers, the Middle East is clearly poised for confrontation and war, even as world powers are convincing everyone to stand down or take a step back. War risk premium is a term I did not hear much until late last year, but that too only sporadically, but now it crops up every other day and alarmingly so. Take the case of gold, which is up almost 29% since early October, that's 2023, and up 18% since mid-February, which is barely 8 weeks ago. Money Control quoted a report from brokerage HSBC saying that escalating geopolitical risks significantly bolster gold as hot and cold conflicts and a record number of elections this year keep the risk thermometer high. Trade risks associated with geopolitical risks are also gold positive. On the other hand, central banks, as we've been saying here, have been buying gold steadily, and this has been mostly led by China and then other countries as well, including India. The buying of gold gathered momentum in the last 2 years, and gold buying is rising, possibly also to switch from US dollars or be less exposed to it. And I'm talking, of course, about central banks. HSBC says the precious metal is also reliable in emergencies and in terms of national emergency or conflict when national currencies may not be redeemable, and then, of course, gold could be mobilized. Now, this, of course, sounds quite logical and practical, except that it does not exactly leave a pleasant sensation behind, given that the fact it reflects a very grim outlook of what could happen in the world and the global economy in coming days or months. I reached out to Jigar Pandit, head of commodity and currency at Sharekhan by BNP Paribas, and I began by asking him how he was seeing the events of the week unfold, particularly in the context of gold prices and demand, and some oil thrown in as well.
Right now, if we see gold, or rather I would say gold and silver, both have been extremely volatile in last few days. If you see on Friday during the late evening India time, gold, silver fell down by almost 1.5 to 2%. And the major reason for that was that the war type situation, or I would say the geopolitical tensions between the Iran and Israel market was expecting that it has subdued, and hence there was a sharp correction. If you see, gold has dropped by almost $90, and so is the case with the silver, also dropped by almost 2.5%. Having said that, the recent update definitely will create a lot of geopolitical tensions and a safe haven buying in gold. So we are expecting the coming week again would be very volatile. And in fact, even the price, even if going down, we are expecting it would be a very, very short lived. And we are expecting price to go up again, maybe around 2,500, 2,050 to $2,600 in gold.
So at that point, that would be an all-time high, isn't it?
Yes, it would be all time high.
If I was looking at some of the brokerage reports, and they seem to be now talking about even $3,000 per ounce, maybe by next year. But is there such a change in, let's say, the way market is perceiving risk nowadays?
Last few reports, we were already predicting the price. When the price was around 2,100, 2,150, we were anticipating price to go to 2,450, followed by 2,600. Because of this geopolitical, the price have moved very fast. So again, now we are expecting 2,600 plus to $3,000, maybe by next year or so. Not only the geopolitical tension, but again, of course, the central banks are buying continuously. In fact, if you see last 2 months, in February and March also, there was a buying by the central banks. So in that case, we see that from last 9 to 10 months, there were continuously buying from the central bank. In fact, if you see the Chinese gold ETF price, it's at premium to by almost 25 to 30% of the actual underlying asset. So that's the demand we are talking about. So Chinese demand is there, central bank demand is there, geopolitical tensions, and of course the interest rate is already on the card. So that is all putting all the reasons is pushing gold very sharply high.
I'll come to oil in a second, and what does this mean from a domestic price? I mean, we're looking at 74,000 plus, I guess, for 10 grams. At this level, do you feel they could still be buying? Because, I mean, while internationally things may move differently, but how will it move domestically?
Domestically, the way price has moved, I think there would definitely be a slowdown in the demand. But as you know, we are a price taker and we are not the price giver in the international market. So even if the demand slows down, will not have a significant impact on the price either in international or domestic price.
I'll come to oil now. What's your sense there? We are at 90.45. I mean, just under $91. So could that also see a jump, because that's obviously more connected to the Middle East tensions?
When I talk about, say, WTI crude, what you mentioned is about the Brent crude. That's around 90.10. In both the cases, of course, there will be a sentimental buying and supply constraint. Fear will always be there. That will definitely push crude oil prices to a little higher level. And in that case, we are expecting crude oil prices, which is ranging around 84, 85 right now. WTI I'm talking about. We are expecting prices to touch by around, say, $90, $91 in coming days.
If I were to come back to gold for a second, you were also telling me that earlier that most people usually take long positions ahead of weekends. And was that always happening? And do you see more of that happening?
As I mentioned earlier, right now the inbuilt war premium in gold price is very, very high. And because of these uncertainties, Generally, most of the big traders, generally what they do is, especially those with the big position either in equity or other asset class also, to hedge their position or to become more safeguard, they go long in gold during this weekend because they are not certain. I mean, they have a fear that in the weekend anything can happen, which has happened today. Such scenario, they were expecting that it may happen anytime. And to hedge their overall portfolio, they went long in gold.
Right. And last question, again, in the context of gold, I mean, are you telling investors to buy in even at these levels?
Definitely, we are anticipating prices to go northward, say around 2,650 to $3,000, but not in near future. Yeah, if this scenario continues, then definitely it will touch to around $2,800 very soon. But by and large, we are expecting prices to even touch $3,000 maybe by next year end. So what we advise to the advisors who are to the clients rather, wait for a little dip and buy on every dip, accumulate gold at every dip for the target of say around anywhere between $2,900 to $3,000.
Right. And which means you're fundamentally asking people to hold on to it as a longer term investment asset rather than something short term,
Yes, yes, yes. And so is the case with silver also.
which has also hit an all time high.
Yes.
Right. Jigar, thank you so much for joining me.
Thank you very much.
Speaking of war risk, Air India has temporarily suspended flights, that is, its Delhi-Tel Aviv flights. Air India operates 4 flights usually between Delhi and Tel Aviv, and it had resumed those flights just last month after a 5-month break, which followed the Hamas terror attack on Israel on October 7th, and the flights were suspended just after that. India is gearing up for power shortages in a way perhaps we've not seen before. It's not just demand for gold which is rising. Demand for power is also set to rise sharply this summer against increased heat waves, which have also been predicted and projected. We've already heard of cities like Delhi gearing up for a peak power demand in June and July of about 8,000 to 8,200 megawatt. The last peak in Delhi was 7,695 megawatts in 2022, and it actually dropped a little in 2023. Now, back to 2024, India is staring at power shortages. There will, of course, be higher energy costs as well, and we'll come to that at a later point. Reuters is now reporting that the government has invoked emergency clauses to activate underutilized gas-based power plants. The government has asked companies to operate these underutilized gas-based power plants in May and June and extend operations of imported coal-based plants until October 15th to meet an anticipated high demand for electricity, according to 2 government orders which Reuters says it has seen. India broadly saw an 8% increase in electricity consumption for the financial year that ended on March 31st. This is apparently the first time this emergency clause mandating companies has been used or rather invoked. India has about 24 gigawatts of gas-based power plants that have been idling or underused for decades thanks to a lack of fuel. Power stations will be informed 2 weeks in advance about those requirements so they can import gas, the order says, and Reuters reports. Torrent and NTPC are amongst the big gas-based power station companies. In another order, also seen by Reuters over the weekend, the government invoked an emergency clause directing companies like Tata Power and Adani Power operating imported coal-fired plants with a capacity of nearly 16 gigawatts to continue operations. The plants were initially allowed to operate until June 30th. So this, of course, appears more like a procedural move, but nevertheless important. GST collection numbers, what do they tell us? A key puzzle most economists and businesses with consumer-facing products and services are always trying to solve is the extent of private consumption and consumption behavior in India. One set of numbers suggests private consumption is subdued. That's not the one I'm referring to here. But goods and services tax collection numbers suggest that it is strong. So which one do you believe? A new exploratory report by rating agency CRISIL sums it up by saying that private consumption is the biggest demand driver for the Indian economy, and understanding how it stacks up across states is helpful for the corporate sector as well as for policymakers. So CRISIL has analyzed GST data for 7 states that account for 95% of total GST collection, which in itself should say something because there are 28 states in all and of course 7 union territories. Now Maharashtra leads with a 20% share of GST collection for all of India, followed by Karnataka. There are more insights, but the key one perhaps is this. The GST numbers 8 years after they kicked in, which is the tax kicked in, reflects the lag effect of reforms. I spoke with CRISIL chief economist DK Joshi and I began by asking him what the GST data was telling us at a broad level, what all does it capture, and then what can we take away? And finally, what are the key trends visible over the last 8 years?
GST is a destination based tax. So it reflects the consumption patterns within the overall consumption within the boundaries of a state. And we find that it correlates quite well with private consumption expenditure. So it can be taken as a proxy for consumption at the state level. But what's also true is that GST collections could increase because of improved compliance, because of improved formalization of the economy. All those impacts get embedded into the consumption number. You would be capturing more consumption. The consumption may not have happened more, but you are capturing more of it. So that also gets reflected in this. The other thing to note is that items like food, alcohol for human consumption, petroleum products, they constitute about 33% of private final consumption expenditure. They are out of the GST net. And some of the services which are also out of the net we don't have information on them. So, but overall, I think since it correlates quite well with the private consumption expenditure, we take it as a proxy for private consumption.
Looking back last 8 years, DK, what is the sense that you have from the numbers that have been coming in and what we can glean as the broader or medium to longer term trends?
Well, I think one clear takeaway is that the reforms pay off with a lag. If you remember when GST was introduced, there were too many glitches, and the revenue story of GST is only now beginning to play out since the last 2-3 years. Once you get rid of the glitches, once you streamline it, it pays off. And this happens with most of the reforms. So that's number one. Second, I think observation from the last few years' data is that GST collections have outstripped GDP growth, so nominal GDP growth. So they're growing faster than that. What we also find is that GST introduction has had positive spillover impact on the income tax collections, because once you are in the GST net, I think it becomes difficult to cheat on taxes, to put it very bluntly. And we have seen that income tax collections in 23-24 have grown by something like 20%. What is also interesting is that almost all states have witnessed growth in GST collections. On the average, between 12 to 15, 16%. Year-to-year numbers could vary. And this is largely because I think GST was introduced at the same time across India. So whether it's a rich state or a poor state, everybody has seen the growth in GST collections.
Again, a contextual question. Now, before GST, we had other taxes. We had state excise, central excise. So GST was the merging of all of this. So are we able to better read what's happening in the economy today as compared to earlier?
Yeah, I think if you get more information on the granular part of GST, I think you'll be able to assess even more, because you will get information on economic activity at the state level, whether goods are doing well or the services are doing well, I think, and also other stuff like consumption pattern across categories of goods. I mean, so all those things will make you understand because this is there is no cascading effect here. So it's a more cleaner information that is available. But the granular part is yet to be available. So I think we are working with the aggregate numbers right now.
I'm going to come to the per capita part and comparison with GDP in a moment. But if you look at the data now over 8 years, and even including the last year, which is 23-24, are you seeing any spikes that are unusual? And if so, or what are you not seeing perhaps?
Well, I think what we saw in 23-24 data till date was that Odisha, the GST collections have been the fastest in about close to 27-28%. So we can't explain it right now. I think you'll need more information to figure that out. So these interstate variations, I think, do happen from point to point, and they are sometimes difficult to explain.
And what about the aggregate numbers? For example, 23-24, we saw roughly similar numbers, let's say 160,000 crores, and then it went up for a month or two, then came down again.
At the overall level, the GST collections have gone up by something like 12%, which is faster than the nominal GDP growth of 9% and also faster than the consumption growth. So I would say that the collections or year to year are continuing to improve faster than the economy is growing.
And which brings me to the other question. So when you look at the GST numbers and then you look at, let's say, other data points we have like per capita income, overall GDP, how does it all triangulate together? I mean, and to what extent does it and does it not?
Clearly, GST is a tax on consumption. We have seen, as I said, GST grow much faster than GDP and private consumption in the economy in 23-24. While interpreting the GST numbers, one has to keep in mind that there are two factors which are influencing tax collections. Number one is the extent of consumption that is happening. And number two is the better capture of consumption in the economy because of compliance and also because of formalization of the economy. Now, it's very difficult to distinguish between these two. I mean, what is contributing to what extent? As I said, since even with this shortcoming, the GST collections per capita correlate quite well with the consumption per capita in a state, it can be considered as a broad proxy for consumption.
Right. BK, thank you so much for joining me.
Thank you, Govind. Always a pleasure.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.